Assalamualaikum and selamat sejahtera to Puan Nur Rashikin and my fellow classmates. So today my group members and I are going to present about requirements of Basel II and Basel III. So let's meet our group members. First we have me, Aina. My name is Aina Christina binti Muhammad Saleh and my matrix number is 01 DKB 20F1019.
Hello, my name is Nora Sila binti Abdul Majah. My matrix number is 01 DKB 20F1015.
Assalamualaikum. My name is Ahmad Naim bin Muhammad Idris. My matrix number is 01 DKB 20F1013.
Hello, my name is Fatin Afika binti Muhammad Fisal and my matrix number is 01 DKB 20F1029.
Hello and Assalamualaikum everyone. My name is Amirul Hafiz bin Muhammad Amin. My matrix number is 01 DKB 20F1021. I am from DKB4.
Now I will explain the introduction of Basel. The Basel Accord was first issued in 1988, whereas Malaysia has been adopting the framework for capital adequacy since 1989, with requirements on capital base and standardized approach for credit risk. The Basel Community and Banking Supervision then issued an update to the framework in 1996, incorporating the standardized approach for market risk.
I will explain about definition of Basel II. Basel II is a set of international banking regulation first released in 2004 by the Basel Committee on Banking Supervision. It expanded the rules for minimum capital requirement established under Basel I. The first international regulatory accord provided a framework for regulatory supervision and set a new disclosure requirement for assessing the capital adequacy of banks. Now, let's move on to the next slide. Building on Basel I, Basel II provided guidelines for the calculation of minimum regulatory capital ratios and confirmed the requirement that bank has to maintain a capital reserve equal to at least 8% of their risk-weighted assets. And the next one is the second pillar of Basel II. Regulatory supervision provides a framework for national regulatory bodies to deal with systematic risk, liquidity risk and legal risk among others. Next, we will be moving on to the three pillars operates under the Basel II framework. Basel II is the second of three Basel Accords. It is based on the three main pillars, which are minimum capital requirement, supervisory review and market discipline. Minimum capital requirement play the most important role in Basel II and obligate banks to maintain certain ratios of capital to their risk-weighted assets. The next one is supervisory review. Supervisory review is the process whereby national regulators ensure their home country banks are following the rules. This pillar required banks to implement internal risk ratings and capital assessment processes with oversight by their boards and senior members. The last one is market discipline. Market discipline refers to the disclosure requirement for individual bank allowing other market players to assess each bank's capital and risk exposures. Under this framework, banks are required to disclose all material information relating to their risk management policies, but enforcement is left to the individual regulators. That's all from me. Thank you, and let's move on to the next presenter, Ahmad Naim.
I would like to present about requirement of Basel II. Basel II built on Basel I by giving rules for how to figure out minimum regulatory capital ratio and reaffirming that bank must keep a capital reserve equal to at least 8% of their risk-weighted asset. Basel II set up three different levels for a bank's regulatory capital. The safer and more liquid the asset, the higher are tier. Tier 1 capital is the bank main source of funding. It is made up of the common stock, disclosed reserve and a few other assets. Tier 1 asset must make up at least 4% of the bank capital reserve. Tier 2 is considered extra capital and is made up of things like revaluation reserve, hybrid instrument, and subordinate loan with medium and long term. Tier 3 is made up lower quality, subordinate, and unsecured debt. Basel II also change how risk-weighted assets are defined. These are used to figure out if a bank has enough capital reserve. The goal of risk weighting is to keep banks taking on too much risk with the asset they hold. Basel II is different from Basel I in that use the asset credit rating to figure out is risk weighted. So that's all from me. I would like to invite next presenter to continue this presentation. Thank you.
Next, I'm going to explain the definition of Basel III. Basel III is an international regulatory accord that introduced a set of reforms designed to mitigate risk within the international banking sector by requiring banks to maintain certain leverage ratios and keep certain levels of reserve capital on hand. Basel III was rolled out by the Basel Community on Banking Supervision consortium of central banks from 28 countries shortly after the financial crisis of 2007 until 2008. During that crisis, many banks proved to be over-leveraged and undercapitalized despite earlier reforms. Next, Basel III measures aim to improve the banking sector's ability to absorb shocks arising from financial and economic stress. Second, to improve risk management and governance, and lastly, to strengthen banks' transparency and disclosure. Lastly, I'm going to talk about 3 pillars of Basel III. Pillar 1 is minimum capital requirements, consists of liquidity coverage ratio, leverage ratio, and capital conservation buffers, and etc. For Pillar 2 is supervisory review process, which is firm-wide corporate governance, managing risk concentration, sound compensation practices, and etc. And lastly, Pillar 3 is market discipline. To enhance disclosure, consists of risk management, which are market risk, credit risk, operational risk, and etc.
I'm going to present about the Basel III requirement. The first tier refers to a bank's core capital, equity, and disclosed reserve that appear on the bank's financial statement. If a bank experiences a significant losses, Tier 1 capital provides a cushion that allows it to weather stress and maintain a continuity of operation. Tier 2 refers to a bank's supplementary capital, such as undisclosed reserve and unsecured subordinated debt instrument. For the third tier, it eliminated an even riskier tier of capital from the calculation. Now, let's move on to the comparison between the Basel II versus Basel III. For the requirement, capital conservation buffer to RWAS, or known as right weight asset, for under Basel II is none, while for under Basel III is 2.50%. For the minimum ratio of total capital to RWAS, for under Basel II is 8%, and for the under Basel III is 10.50%. Next, for the minimum ratio of common equity to RWAS, for under Basel II is 2%, and for under Basel III is 4.5%. Next, Tier 1 capital to RWAS for under Basel II is 4% and under Basel III is 6.0%. For the leverage ratio for under Basel II is none, and for under Basel III is 3.0. For the leverage ratio for 8SIFI as in US, for under Basel II is none, and for under Basel III is 8.0. Next, counter-cyclical buffer for under Basel II is none, and for the under Basel III is between 0% to 2.5%. Minimum liquidity coverage ratio for the under Basel II is none, and for under Basel III is TBD, to be determined for 2015. And lastly, net stable funding ratio, or known as NSFR, for under Basel II is none, and for the under Basel III is TBD, to be determined.
I'm going to present to you guys about differences between Basel II and Basel III. Differences between Basel II and Basel III. The first one is type. Basel II was established to introduce supervisory responsibilities and to further strengthen the minimum capital requirement. For Basel III, focus to specify an additional buffer of equity to be maintained by banks. For risk focus, Basel II introduced a three-pillar approach to risk management. For Basel III, assessment of liquidity risk in addition to the risk set out in Basel II was introduced by Basel III. Next, risk considered. Basel II includes a wide range of risks including operational, strategic, and reputational risk. For Basel III, it includes liquidity risk in addition to the risk introduced by Basel II. The last one is predictability of future risk. For Basel II, it is looking forward compared to Basel I since the capital calculation is risk sensitive. For Basel III, it is looking forward as macroeconomic environmental factors are considered in addition to the individual bank criteria. Moving on to my next slide, conclusion. The differences between Basel II and Basel III Accords are mainly due to the differences between their objective, which they were established to achieve. Even though they were widely different in standards and requirements, they presented are navigate in such way to manage banking risk in light of swiftly changed international business environment. That's all from us. Thank you.